lending cryptocurrency and staking cryptocurrency are both ways of earning additional passive cryptocurrency income. And although they can seem similar in some respects, there's also important differences between these two ways of earning cryptocurrency, which I will discuss in this video. Hey everyone, and welcome back. This is the Part-Time Economist, and in today's video we're going to be talking about the differences between staking and lending cryptocurrency. Now, at the very basic, yes, they're both ways of earning additional cryptocurrency income, a passive income stream, and for that, many people will consider them very similar. However, there's also some really important differences between the two, which I do want to talk about. But before jumping into my video, I want to say that I got the idea from this topic from Scott Cunningham, fantastic crypto YouTuber. So if you haven't checked him out, be sure and look at some of his content because it's top-notch stuff that he usually puts out. So with that being said, what I wanted to do was really talk about the differences between staking and lending, because a lot of people say, hey, I'm earning passive crypto and that's all I really care about, and that's fine. But there are some important differences if you want to know kind of the nuts and bolts of how it works, or if you really kind of want to contribute to a certain cryptocurrency project. So let's start at the very basics with lending. Now, with lending, I'm starting there because it's the most familiar to most people. So if we're talking about lending, it's very similar to lending through a bank, right? So let's just start the most basic level. If I make a loan to Fred, and Fred's my buddy and he doesn't pay me back, the problem with that is it's going to be very hard for me to go and get that money, right? Maybe Fred keeps kind of blowing me off and saying, yeah, I'll pay you, and he never says, I'm just not going to pay you. He just kind of delays it. What am I going to do? Am I going to take Fred to court? I'll probably spend more money than I'll get, right? So we typically will lend things through a bank. What do we do when we lend with a bank? Well, we take our money, we deposit it in the bank, and then the bank assumes that responsibility of trying to find someone out there that they can lend it to. They take on the risk. So even if they lend money to Fred and Fred never pays it back, I will never personally lose my money. So when we think about lending, the thing I want you to think about is we don't really care who our money is getting lent out to. All that we care about is that we're getting that money back. And that's kind of how cryptocurrency lending will work. Again, I'm not recommending or endorsing any specific platforms, but a typical example of a cryptocurrency lender could be Nexo. Other examples include Celsius, BlockFi, Crypto.com, I think does it. There's tons of them out there, but the basic idea, you can deposit a variety of cryptocurrencies, Cardano, Chainlink. Let's go with Cardano. We put in a certain amount. Let's suppose we only have $100 worth to deposit. We put that in and it says, hey, in 24 months, it gives us how much we will have. So we're going to make $12.56 for lending that crypto out for 2 years. Now, that is lending through a custodian. Now, that's very traditional, right? And I started with that example first because we can think of Nexo or any of these kind of like a cryptocurrency bank. We give our cryptocurrency to them. They are responsible for the safekeeping of that cryptocurrency, for taking care of the loans, from collecting all the interest, and then at the end of the day, they will give us whatever interest is due to us. Some of these will even give you a tax statement, which is one of the advantages of using them. Now, all of these are what is called centralized finance. In order to do this, we've got to create an account, we've got to give our identity documents, and they basically verify us. Now, a different way of lending is through decentralized finance, and this is more in the spirit of traditional cryptocurrency in that I don't have to submit my bank documents. I don't have to prove who I am. If I've got cryptocurrency in a Web3 wallet like a MetaMask, I can simply come here and I can lend through a decentralized protocol. Again, I can lend a variety of cryptocurrencies. I can get a certain APY on those cryptocurrencies. And the difference here is that I'm not going through a financial institution. With this type of lending, I'm lending to a smart contract. So I'm sending my cryptocurrency to a smart contract. There's not necessarily a whole lot of human intervention involved, right? I don't have to worry about Nexo going bankrupt or anything like that. I'm lending through a smart contract. We're kind of pulling the human element out of it. So some people prefer that. Some people prefer the idea of lending through a third-party custodian like Nexo, something like that. But at the end of the day, the core concept of lending is we are giving someone our crypto for a period of time. They are paying us interest on that. It's strictly kind of a financial transaction, right? I have this money. I don't need it right now. I can lend it out and then I can have more money in the future. It's strictly a monetary advantage that we're trying to gain from lending our cryptocurrency. On the flip side, however, we have something known as staking. Now, staking is really unique to cryptocurrencies, and which is why I didn't start with it. Lending, as I said, is very traditional. Yeah, cryptocurrency is new, but the process, the idea behind lending is something that anyone with a traditional bank account is already familiar with. Staking, by contrast, is something that you really can't do at all with traditional monetary instruments. Staking allows us to help play a role in securing the network. Now, what does this mean? Cryptocurrencies, as many of you may know, are a decentralized network, and people will do transactions. They're trying to validate transactions. How are those transactions validated? Well, in a proof of work system, different computers solve puzzles, and they try to win these puzzles and determine who's going to author the next block. With proof of stake cryptocurrencies, and again, I've done videos, proof of work, proof of stake, you can check those out if you want, but with proof of stake, what happens is, let's suppose I have some cryptocurrency tokens and I say, I want to stake these part-time economist tokens. Well, when it comes time for a transaction to be validated, the network is going to randomly assign the validator based in proportion to how many part-time economist tokens they have staked. So if I've got, let's suppose I staked 10% of the total supply, maybe I get a 10% chance of authoring the next block. Someone that has a 50% stake, they would have a 50% chance. Now, this is a gross oversimplification, but I'm just trying to put the idea in your head that the more you stake, the more possibility you have of creating the next block. So in essence, what you're doing, you're not just lending money out to say, I want money, I want income. What you're really doing is you're playing an essential role in validating transactions and securing the network. And in exchange for doing that, you are going to earn transaction fees or newly minted tokens. Again, beyond the scope of this video, but different cryptocurrency projects will do this differently. Some cryptocurrency projects, if you are designated to create the next block, the next batch of cryptocurrency transactions and approve them, you might get the transaction fees. Other cryptocurrency projects might not give you a share of the transaction fees, but they will create newly minted cryptocurrency and give that to you as a reward for authoring that block. So again, there's hundreds, different cryptocurrencies. They all have their own systems, but the general idea is that with staking, number one, you get a higher chance of creating the new block the more you stake, and you get a reward for creating that new block. So with that being said, I want to give a couple differences with regard to trustlessness. So when you are lending cryptocurrency, right? If you are lending through a centralized institution such as a Nexo, a Celsius, a BlockFi, you're trusting that they are going to keep that cryptocurrency safe for you. If a hack happens, if the lender doesn't repay, you're trusting that that centralized custodian, the Nexo, the Celsius, that they will make good on that. And in fact, most of the times they will have very hefty insurance premiums that they will use to help cover any losses. But again, you're still trusting them, right? It's not FDIC improved. It's not FDIC insured. The government's not reimbursing you necessarily for that. You're putting your trust in those companies. By contrast, if we look at something like a decentralized financial lending protocol, you're putting your trust in those smart contracts, that the person that has authored those contracts, that the firms that have audited them have made sure there's no bugs, that have made sure there's no loopholes. Now, various decentralized financial protocols will also sometimes have their own decentralized insurance funds, but think of those as secondary. Think of those as kind of a backup. The main goal with these DeFi protocols is we're trusting the code. We're trusting the programmers that have written that. Now, when we are actually staking, we're securing the network. So when we think about staking, we're not trusting a company. We're not trusting a single smart contract. Rather, we're trusting the underlying network itself, right? So, Depending on your perspective, everyone's going to have different risk tolerances of what they want. But the important thing is to understand two key differences. Number one, the difference between lending and the difference between staking. So with lending, we are strictly trying to make some money, right? We don't care about the network. We don't care about signing or approving transactions. We just want to say, hey, I've got this Bitcoin. I don't need it. I'm going to lend it to you and you give me more Bitcoin. By contrast with staking, yes, of course, we're doing it for an incentive. We are doing it for the ability to earn additional income, but we're also playing a role in securing the network, making sure that everything goes smoothly. So, which is best for you? Obviously, I am not a financial advisor and this is not financial advice, so I am not even going to give you a guess. However, I will say that different situations are suited for different purposes. One thing I will point out, not all cryptocurrencies are stakeable. For example, Bitcoin currently is not a stakeable cryptocurrency because it uses the proof of work algorithm. So sometimes cryptocurrencies that you can't stake, you will be able to lend. For example, I can't stake Bitcoin, but I can lend Bitcoin. So if you've got one of those cryptocurrencies, your choice is pretty obvious for you. If you've got a cryptocurrency that can do both, it can be staked and it could be lent. Just to give an example, let's suppose that I can stake the Tron cryptocurrency. Well, I can also lend the Tron cryptocurrency. Which do I do? Well, it depends. It's up to you. Sometimes you can find a higher interest rate from lending. Maybe sometimes you can't. Maybe you really are passionate about the Tron network. You want to sign, you want to validate those transactions, you want to feel like you're playing a part, then perhaps staking is the right way for you to go. But again, completely up to you, different situations. I'm just trying to show some of the pros and cons, the differences between those different ways of earning passive cryptocurrency income. So, as always, I'd like to thank you for watching. I hope you found the video useful, and as I always say in these videos, if you got any other cryptocurrency topics, specifically of an educational nature, I can't really do a whole lot with endorsing or recommending a specific coin, but if you've got broad general questions about cryptocurrencies, how they work, why they're useful, things like that, I'd be more than happy to hear your suggestions. So leave them down below and I will see you next time.